Hey, what's up, my friends? So, welcome to the Ultimate Technical Analysis Trading Course for beginners. And here's a true story. When I first started the financial markets, I wasn't a technical trader. I was actually more of a fundamentals guy. I was trying to emulate Warren Buffett to find the next stock that I can hold for the next 30, 40 years. And as a fundamentals person, right, what I realized is that by the time the fundamentals of a stock has turned bad or sour, I would have lost a huge chunk of money already. So that kind of, led me to find something else. And that's where I got introduced to technical analysis because it's more faster in that sense. So when I entered the world of technical analysis, I was overwhelmed because there's just so much information out there. You got indicators, support resistance, chart patterns, candlestick patterns, RSI, MACD, pivot points. Where do you even begin? What should you focus on? So it's after years of trial and error, researching, right, that I realized that less is more when it comes to trading. So this is why in today's training, okay, I want to shortcut your learning curve. I don't want you to go through the same, misery that I went through with technical analysis. So here's what you learn in today's training. Number one, why 95% of traders lose money with technical analysis and how you can avoid it. Number two, how to know when to buy, sell, or stay out of the markets. Number three, how to identify the best levels to trade so you can find low risk and high reward trading opportunities. Number four, how to avoid jumping into trades too early so you can avoid unnecessary losses. Number five, when to take profits before the market turns against you and wipe out, right, all your open profits. And do you hate to watch, your trade, right, going to the moon after you exit the trade? Then, I'm going to share with you this one technique that you can implement, right, that prevents that from happening. And along the way, I'll share with you a ton of charts, examples, and much, much more. Sounds good? Then let's get started. So, my definition of technical analysis is this, right? Technical analysis is using past data like chart patterns, candlestick patterns, volume, indicators, etc. to help you make a trading decision. And before we dive deeper into technical analysis, which is what this training is all about, I want you to be aware of two mistakes, right, that many traders make. Many losing traders make this mistake. Number one, they add too many indicators, tools, right, to their charts because it makes them look like a professional trader. But here's the thing, if you have a chance to look at the screens, the monitor of, pro traders, you will realize that their charts are actually quite empty. They have tools on it, right, but it's not a lot. It's usually relatively little compared to new traders who just got started in trading. They add the moving average, RSI, MACD, make their charts look so complicating, thinking, it makes them look like a real trader. But that's usually, further away from the truth. Okay, so the reason why you don't want to add too much tools to your chart is because you will get analysis paralysis. You will get conflicting information and you will feel overwhelmed. Alright, it's like, having too many chefs to make one soup. You have too many chefs, each one add their own flavor, their own spice, their own tweak to the soup. The soup is going to taste like crap. And it's the same for your trading. If you add too much stuff to your charts, right, you will hurt your own trading results. Mistake number two, you don't have a framework to work with. So I know this sounds a bit vague, so let me explain. So let me ask you, let's say, you want to build a house. How would you go about doing it? Will you just, go out there to a store and let me buy a toilet bowl because I need a toilet bowl for my house. Oh, here's a sofa. Let me buy a sofa. Oh, I need a bed. Let me buy a bed. And you go back home, you put your bed down here, you put your sofa, you plant a toilet somewhere beside your bed and, just like this. I hope not, right? Because if that's what you're doing, you will live, right, in a pretty darn ugly house. So what most people will do is they have a blueprint. They have someone to design, right, the framework, the layout of their house. Maybe if it's a 3-story house, the first story could be building a kitchen on the first floor. Then maybe you have a living room and a guest room on the first floor. So this is where you kind of play and entertain yourself and cook just for the first floor of the house. Second floor could be where you're resting. So you have more bedrooms, maybe 5 to 6 bedrooms on the second floor. You have more beds, you have toilets, right? So you don't have to wake up middle of the night and walk 50 meters to your toilet and stuff like that. And maybe the third floor is your home office or your man cave or whatsoever. You have all the latest technology, entertainment on the third floor. And this is how you would go about, building your house. You have a framework, something to refer to, right? To help you, make your purchase decision so you know where, things will be. And this is the same for trading. You must have a framework. Okay, so this, right, will be core, right, to today's entire training because the framework that matters, right, is this. There are only 4 parts to it. Very simple, but I'm going to dive deep into each and every single part. Number one, market structure. This, right, is in essence, right, trying to find out what is the current market condition so you know what to do. For example, if you know the market condition is in an uptrend, then you look for buying opportunities. If the market condition is in a downtrend, then you look for selling opportunities. So don't worry, right, I'll dive deep into this aspect later on. Second part is area of value. So just because a market is trending doesn't mean you want to blindly hit the buy button, because the market could be overbought, right, and about to make a reversal or a pullback. So this is where you want to identify areas of value, right, where you can find a low risk entry to enter a trade. In essence, right, you're trying to find out where on the chart, right, should you buy or sell. The third thing, entry trigger. This answers the question, when exactly do you buy or sell? When exactly? What is the thing, right, that would trigger you to get into a trade? And finally, once you're in a trade, right, you must also plan your exits. What if the market moves in your favor? Where will you take profits? What if the market moves against you? Where will you cut your loss? So in essence, this is the framework, right, that we will be learning more later. And for now, let's do a quick recap. Number one, technical analysis is simply using past data to help you make a trading decision. You must have a framework to work with. If not, you'll be lost, right? Like, blindly, building your home, right? If you don't have a framework, you don't have a blueprint, you will get lost, you will get confused, and you will, have a horrible looking house, right? So if you don't want that, start with a framework. And the framework that I've shared with you is using market structure, identifying your area of value, defining your entry trigger, and then planning your exits. So in the later section, right, we will dive deep into each of this component within the framework. So let's get started. Now, in the next section, you will learn, right, how to use technical analysis to define the current market conditions, so you know whether to be buying, selling, or staying out of the markets. So let's move on. So let's talk about market structure. So market structure seeks to answer this question. What to do, right? What should you do in different market conditions? Should you be looking for buying opportunities, selling opportunities, or to stay out of the markets? So the way this works is that market structure, it helps you to define the current market condition. So you know whether to be buying, selling, or staying out of the markets. Make sense? So how do you identify, right, market structure? Or if you want to phrase it, right, how do you identify the current market condition? Well, to do it right, there are two techniques I want to share with you. And bear in mind, there are more than two ways to do this, but I just want to share with you two useful techniques, because if I share with you too many techniques, you get overwhelmed, get confused, and you give up. So I'll just share with you two useful ones. Number one, candlestick chart, and number two, moving average. So let's have a look at this two, right, in more details. So first and foremost, right, let's talk about candlestick chart. What exactly is this? So candlestick chart is a method of reading a price chart. So it's not the only way to read a price chart. You can use things like bar chart, Renko chart, etc. But we'll stick to candlestick chart for this training. And a candlestick chart, it consists of individual candlestick patterns. So candlestick patterns is something that you are probably familiar with. It looks something like this. This is one candlestick pattern. Could have a little bit of upper shadow and lower shadow. Sometimes this could even be, let's say a darker color one. Could be like, let's say in this case, black color, or even red to signal lower close, right? Something like this. So this is what we mean by candlestick pattern. So a candlestick chart consists of many individual candlestick patterns. So it's just like a forest, consists of many individual trees. So we will talk more about candlestick patterns later on, but for now, this is kind of like the macro, the big picture. I want to share with you how do you actually use candlestick chart to identify the market structure. So first thing first, right? Identifying market structure using candlestick chart. So there are three types of market structure you want to pay attention to. Number one is an uptrend. This consists of a series of higher highs and higher lows. So it looks something like this. Price hits higher, makes a pullback, breaks out higher, makes a pullback, and then breaks out higher. So when you take a step back and look at this, you can see a series of higher high, and higher low, higher low. Make sense? So this is what we call an uptrend. Next one, we have what we call a downtrend. So this is in essence the opposite. The price is heading lower over time. So down, it makes a pullback, heads down lower, makes a pullback, heads down lower. So if you look at this big picture wise, you see a series of lower high, and lower low, lower low. And finally, we have what we call a range market. This is where the price is contained between the highs and the lows, kind of like getting stuck in a box. So let's say price goes up, comes back down, goes up, comes back down, goes up, comes back down. So you can see that it's stuck between these highs and these lows. And this is what we call a range market. So let me share with you a few chart examples, right? So you know what we're talking about. So first one here, this is the chart of S&P 500. Let me ask you, what is this market structure? Well, I hope you can see that this is a uptrend. Why is it an uptrend? Because you see a series of higher lows, higher low, higher low, higher low, and higher high, higher high, higher high, higher high. Next one, what about this? Platinum. So I just want you to pay attention to this chart. Is this in an uptrend, a downtrend, or a range? So one tip that I have for you is that if you're not sure, take 5 feet away from your computer, just walk 5 feet back, look at the chart, right, and ask yourself, is the chart moving higher or lower, or is going nowhere? So if you look from left to right, I'm sure you can agree that this market, which is platinum on the daily time frame, it's heading higher over time from left to right. And if you look at the more granular details, you see a series of higher low, higher low, higher low, higher low, higher low, higher high, higher high, higher high, higher high. Of course, I didn't draw every higher highs and lows on this chart. The main thing is just to pay attention to the major swing points, right, and see whether is it heading up higher, lower, or just stuck getting nowhere. What we call a range market. Another example, dollar against the Norwegian kroner. So what we can do is go use this this platform I'm using is called TradingView. You can click reset a chart and just zoom out a little bit, and then ask yourself, is this market heading higher or lower over time? So we can see series of lower high, lower high, lower high, lower low, lower low, lower low. We can see that this market is heading down lower. It's in a downtrend. And since the market, let's say it's in a downtrend, what do you want to be doing? I hope you are looking for selling opportunities. Why selling opportunities? Because this is the path of least resistance. Because if you know a market has been heading down lower over the last few months, there's a good chance that it will continue heading down lower. So you're going to look for selling opportunities. Likewise, if you see a market that's, for example, this S&P 500, heading up higher over the last few months or even the last few years, then you want to look for buying opportunities because this market is likely to continue higher. And you can see this is why we want, first and foremost, right, want to define the current market conditions so we know what to do. To look for buying opportunities, selling opportunities, or to stay out of the markets if it's something that we don't want to trade, we're not comfortable with. So have a look at another example. This one again. UK 10-year gilt. If you look at this chart, is this in an uptrend, downtrend, or range? So look from left to right, you can see this market making a series of lower high, lower high, lower high, and lower low, lower low, lower low. Okay, now let's move on into something different. How about pound Canadian? Now, is this in an uptrend, downtrend, or range? It's a uptrend. Now I'm just kidding, right? It's a range market, right? Why is this a range market? Again, range market is where the price is contained between the highs and the lows. So it's contained between these highs over here and these lows over here. So one thing to point out is that this is not an exact level on the chart. You should treat this as an area. So if it helps, you can use tools like a rectangle tool to draw this as an area like this, or maybe even another one over here. So this way you can treat this like an area on your chart. And this is another area on your chart between the highs and the lows. And this is where we call this market, or we treat this market as a range market contained between the highs and the lows. So one more example before we move on. This one here. Silver. Is this in a range market or an uptrend? So if you look at the chart, right, as it is right now, I would say that this is in a range market. This market is contained between these highs and then these lows. But if you zoom out a little bit more, you might now say that this market could be in an uptrend, right? Yes, it could be if you zoom out your chart like this, but I would argue more towards a range market, as you can see that it's still stuck between these highs and these lows over here. Yep. So I would say that this is a range market. And of course, what I've just shared with you is using candlestick chart to define the market structure, but it's not the only way, because you can also use tools like moving average, which I'll cover next. So what is moving average? So moving average is an indicator that seems to follow the price. So if you see the price heading up over time, right, your moving average will be pointing up higher. If you see the price heading down lower, you can expect your moving average to be pointing down lower as well. And why is that? And that's because of the math behind it. So let me explain. So it's nothing too complicated. It's going to be pretty simple, I promise you. So the math behind moving average, or rather the idea behind it, is that moving average calculates the average price over X number of period. So let's say if you're looking at a daily time frame and you have a 5-period moving average, what this does is that it calculates the average price over the last 5 days, since it's a 5-period moving average. So let me show you how this works. So let's say you're looking at the chart and you have bars like this. This is the first candle. This is the second candle. This is the third candle. This is the fourth. And let's say this is the fifth. right? 5 candles on the chart. And let's say the closing price of this 5 bars is, $1, $2, $3, $4, and then $5. So this, right, the first candle means the price closed at $1. Second candle means the price closed at $2. This one closed at $3, this candle closed at $4, and this candle closed at $5. So let's say you overlay this chart with the 5-period moving average, right? What will the value of your moving average be? Well, it's going to be pretty simple, right? What you're going to do is to add the total, right, of this closing price. So 1 plus 2 plus 3 plus 4 plus 5, and you divide by 5 since we are calculating the average price over X number of period. Our X number of period in this case is a 5-period moving average. So you take 1 plus 2 plus 3 plus 4 plus 5, divide by 5. And if you do that, okay, your answer will be along the lines of divide by 5 equals to $3. How do I know that? You can just pull out your calculator and you'll see that this average of this 5 candle, the average price is 3. So let's say we add one dot over here, right, at this price point. I'll explain what this dot means shortly. So now let's say a new candle has formed, right? Price is closed higher on this 6 candle over here. And let's say it closed at $6. Now, what is the new 5-period moving average value? So what you're going to do is you will now, okay, take the most recent prices, right, over the last 5 candles. So 1, 2, 3, 4, 5. So you take 2 plus 3 plus 4 plus 5 plus 6. You divide by 5 and you get the value of 4. Now you might be wondering, hey Rayner, what about this first candle number 1? Well, we'll ignore it because we are calculating the 5-period moving average. We are just looking at the 5 most recent candles. So in this case, right, we have 6 candles over here. We will ignore this one, the oldest one. So this is the 5 most recent candles from here all the way to here. So again, we just calculate the average of this total value here, 2 plus 3 plus 4 plus 5 plus 6, divide by 5, and you'll get $4. And what you'll do is you add in, let's say you draw another dot over here. So if the price keeps, going up higher, what you can do is you realize that your dots gets higher and you connect the dots, it will appear as a moving average on your chart. And that's how it works. Okay, so hopefully you got some aha moment down here. Okay, so this is just some simple calculation which I've, shared with you earlier. So now, the key thing is this, right? How do you actually use moving average to define the market structure? So let's find out. So for an uptrend, what you can do is when the price is above the 200-period moving average, you can say that the market is in an uptrend. In a downtrend, right, is when the price is below the 200-period moving average. So some of you might be wondering, hey, Rayner, why 200-period moving average? Well, there's really nothing magical about this, but when we use 200, right, it will take into consideration, right, 200 bars on your chart. So it will give you like a long-term guideline to whether this market is heading higher or lower. So this is kind of a way to help you define the long-term trend. And finally, the market is in a range, right, when the price chops up and down the 200-period moving average. So let me just show you. So for example, Euro against the USD, I'll add in the moving average here. So if you're wondering how to do it, right, just go to indicators, you look for moving average. Right, you can see over here, just click on this and the line will appear. So in this case, I already have it on my chart. And if you look at Euro against the US dollar, you can see that this market is in an uptrend. The price is above the 200-period moving average. Now, if you look at the dollar against the South African rand, you can say that this market is in a downtrend because the price, which is here, is now below the 200-period moving average. And if you look at this one over here, pound against the Canadian dollar, you can see that this market is in a range because the price, right, you can see it's chopping up and down the moving average. Okay, so we can conclude that this market is in a range. And that's how you can use moving average to help you define your market structure. Okay? So let's do a quick recap. Number 1, market structure helps you to define the current market condition so you know whether to be buying, selling, or staying out of the markets. So for example, if you see a market in an uptrend, what do you want to be doing? Well, you want to look for buying opportunities. That's the path of least resistance. If you see a market in a downtrend, what should you be doing? You should be looking for selling opportunities because the market is heading down lower over time and there's a good chance it will continue to head down lower. And finally, if you see the market is in a range, then you can look to, buy low and sell high, buy near the lows of the range and sell near the highs of the range. And I'll explain how you can do all that in the later section. But for now, just understand, what is market structure and how it can, help you alert you, right, to what you should be doing at any one point in time. So market structure consists of uptrend, downtrend, and range. You already know this. And finally, you can use a candlestick chart or moving average to help you define market structure. So now at this point, right, you have, learned market structure, but it's just the first step, because a market could be in an uptrend, but it doesn't mean you want to blindly, hit the buy button, because the market could be getting ready to make a pullback or even a complete reversal. And the last thing you want to do is to buy high and sell low. So this is why it pays, right, to be watching, right, for your areas of value on the chart so you can better time your entries. And this is what we'll cover next. So, area of value. And by the way, if you're enjoying this training so far, smash the thumbs up button. If not, hit subscribe. So where was I? Area of value. So area of value, in essence, right, helps you to answer this question: where to buy or sell. So if you recall, market structure tells you what to do. Should you be looking for buying opportunities, selling opportunities, or maybe to stay out of the markets totally? For area of value, it tells you where on the chart to buy or sell. So I define area of value like this, right? Area of value helps you to identify areas on your chart where buying or selling pressure could step in. So let me explain this in more details. So how do you identify area of value? So again, there are many techniques that you can use, but for this training, I'll share with you two: support and resistance and moving average. So let me explain. So what is support and resistance? So support is an area on your chart where buying pressure could step in. So if you look at this, right, let's say price goes up, comes down, goes up, comes back down, goes up, comes back down. Now, from the looks of this, right, we can say that this is an area of support, because this is where previously the price has bounced off once, twice, and now possibly a third time over here. So this is what we call an area of support. Okay? An area on your chart where buying pressure could step in and push the price higher. On the other hand, we have something called resistance. This is an area on your chart where selling pressure could step in and push the price lower. So it looks something like this. Let's say, price is in a downtrend, comes up, bounce up, comes back down, goes up, comes back down, goes up. And we can draw this as an area of resistance. Price got rejected once, twice, and now maybe a third time over here. This is what we call an area of resistance. Is where potential selling pressure could come in and push the price lower. So this is the opposite of support. And another thing to add is that when support is broken, it could become resistance and vice versa. So for example, let's say market is in a range like this. Okay, it goes up, comes down, goes up, comes down, and breaks out of the range, breaks out of resistance. Now when it comes back down lower, this area of resistance, this previous area of resistance, right? Resistance. Now once it breaks out of resistance, it could now become support. This is what we call previous resistance, which now become support. So likewise, if support is broken, it could now become resistance. So let's say price is in a range, then it breaks down below support and it comes back up. Now previous support could now act as resistance, and you can actually anticipate, right, that the price could reverse lower from here. Okay, so this is what we mean by when support is broken, it could become resistance and vice versa. So let's have a look at some charts so you know what I mean. So first one here is platinum. You can see the support and resistance here in action. So this is, you can see previous resistance, price then, hit down lower, tested once, then had a massive slide off. Price then came back and retest resistance, hit down a bit lower, retest it, hit lower, then finally it broke out. Previous resistance become support. Then you continue up higher, pull back, hit up higher, pull back, and then breaks out of this resistance. Comes back, previous resistance now becomes support. It hits up higher, pull back, hits up higher to kind of where it is right now. Another example, euro against the Australian dollar. So for this one, you can see that this market is in a downtrend series of lower lows and lower high, lower high, lower high, lower high. So okay, we're not talking about market structure now. Now we want to pay attention to the support and resistance. So if you look at this one over here, you can see over here, this previously is support. Okay, price broke below support and retest previous support become resistance. So it's a bit far away from this area of support, but you want to bear this in mind. It's not an exact level or line on your chart. It's an area. Okay, so this had a bounce over here, a rejection at this previous support which became resistance. Then price hits down lower, retest previous support which became resistance, hits down lower, comes back up, pulls back, and heads back into this area of resistance to where it is right now. So you can see support and resistance here in action. And finally, Another one is a pound Canadian. You see that this market is pretty much just stuck within this range between these highs, which is resistance, and this lows, which is support. And one thing to add is that you can also, if you want, you can, use a tool like the rectangle tool to draw or identify your area better like this. Personally, I like to draw it as lines, even though I treat it as an area. But for those of you who prefer to draw it as a box, this is something that you can do as well. Okay, so this is kind of like personal preference, just a tip to share with you. So now, let's talk about how, right, to draw support and resistance, shall we? You might be wondering, hey Rayner, how do you draw these areas, man? So that's what we'll cover right now. So a few things to share. Number one, if the market is trending, you only want to draw the two most recent swing points. So let me explain. So let's say if the market is in an uptrend, right, hit higher, pull back, hit higher, pull back, hit higher, pull back, and hit higher. So at this point, you have, a number of swing low. You have 1, 2, 1 here, 2 here, and 3. But my suggestion is to draw the two most recent swing low as support, meaning you just draw a support like this, and then another one over here. Why do you not want to consider this one here? And it's very simple, because when the market is trending higher, right? Yes, it could make a pullback. And where could it pull back into? I'm guessing probably into one of these areas over here, this or this. The market can pull back into this swing low, this lower one, but if it does, right, then you would realize that this market is no longer in an uptrend, because if the price could come back all the way down here into this level here, you can see that, you can imagine that this uptrend is no longer intact. It's maybe even in a downtrend. If the market is in a downtrend, then what the heck am I doing trying to buy at this level? So this is why I only pay attention to the two most recent swing lows. And don't worry, I'll share with you a few chart examples later on, but that is how I would draw my support and resistance in a trending market. So likewise, if the market is, let's say, heading down lower, and you have numerous swing highs to reference, I would just, draw my resistance possibly at this one here and at this one here. And of course, right, if this is a previous support which could become resistance, I would also, highlight it on the chart. But in terms of swing points, right, the swing highs, this would be the two most recent swing highs that I would pay attention to. On the other hand, if you have a range market, then it's pretty simple. Just draw the highs and lows of the range and adjust it, right, to get the most number of touches, right? So I'll explain that shortly. So let's have a look at a few charting examples. So this is Euro against the Japanese yen. This is the daily time frame. Just reset, okay? So you can see over here, where should we draw our area of support? Now, the way I will do this is here. I will take this level here and draw one here. This is the most recent swing low. And another one over here, and that's it. Now, this will be the two area of support I will pay attention to, but also bear in mind that this over here could be previous resistance which becomes support. Remember, once price breaks above resistance, it could become support. So this is actually another level that's worth, right, paying attention to, and I will draw it on the chart. So if you ask me, right, for this uptrend, this will be my area of support on this chart. Why don't I draw, let's say, over here or over here? Very simple. If the price can come back all the way down into these lows over here, this could be in a downtrend already. So instead of, wanting to buy at this support, I would rather be looking for selling opportunities at this previous area, where previous support could become resistance. So I'm going to shift, right, my dynamics, right? I'm no longer looking for buying opportunities, because if the market is in a downtrend, we should be looking for selling opportunities. So this is why I just pay attention to the most recent swing points in the market. Another one, dollar against the South African rand. So same thing. What is the market structure? If you look at this market is in a downtrend. So pay attention to the two most recent swing points. It will be this one here and possibly this one over here. Okay, so this will be the two areas on the chart that I will pay attention to. This is where previous support could become resistance. And this, right, clearly is an area of resistance, right, tested once, 2 times, 3 times, and 4 times over here. So the previous example, I had 3 levels. This one, I have 2. So there's some kind of discretion over here. It's not like an exact science where you can only have 2. No, if the chart, right, makes sense, if it permits, right, I can have, 3 potential support resistance areas on the chart. Okay, and one last final example. Okay, so this one, dollar USD against Singapore dollar. So if you look at this, you would see that, is this in a downtrend or is this in a range? So if you zoom out your charts, right, you can see that this one long-term wise, it's in a downtrend. But if you zoom in a little bit like this, right? You would say that, this is not exactly like a downtrend. This seems like a little bit more of a range. And I would say you're not wrong. So the way I would do this is, again, I would draw, right, the key areas on the chart. So as of right now, which is the nearest swing points, right, relative to the price right now. So if you see the price right now, it's over here. The nearest major swing points on the chart is here, between these highs and these lows over here. Okay, so you can see this is how I would draw my support and resistance for this particular chart over here. This is the highs and this is the lows. So one thing to point out is that, recall earlier I said that I would adjust it to get as many touches as possible. So if you look at this, right, I can actually draw my resistance smack, right? Okay, I would say I could draw it. No, this is actually okay. So let's talk about this one. This lows, right? I could actually draw it maybe at this extreme point, okay, at this extreme low over here. But why don't I want to do that? Because I mentioned earlier, I want to get the most number of touches. So if you just look back in here, if I draw at this extreme point, I will neglect this low over here, and I don't want that. So let me shift it up slightly higher so I can also take into consideration this low. Okay, so I have 1 touch, 2 touch. Make sense? So same for here, right? If I were to draw at this level, I have 1 touch, 2 touch, and 3 touch. Compared to, let's say, I were to only, shift it up higher. The reason why I said this is fine, because if you look back here, you get a number of touches here and here as well. But for me personally, I want to take into account the most recent touches. I want to get the most recent touches together. So I'm going to adjust this slightly lower and take into consideration this as well. This one here, 1 touch, 2, and 3. Okay, so let's have a look at another example. Pound against the Aussie. So again, this one here, the way you draw your support and resistance, you can draw at this extreme high. But if you were to do that, then you would, neglect quite a bit of levels. You actually ignore this one here, and so what I'll do instead is that I would prefer to adjust this slightly lower to get the most number of touch. So when I do that, I now have this over here, 1 touch, 2, 3, 4, and 5. Great. So same for this one and the lows over here, drawing this area of support. I don't want to draw it at the extreme level. I want to adjust it so I can get the most number of touches. So I'll adjust this slightly up higher. And now I have 1 touch, 2, and 3. And this is my area of support. Okay, and this of course is my area of resistance. And that's how you go about drawing your support and resistance on your chart. And of course, right, this needs practice. It's not like, watch a 5-minute video and you become a pro. No, you got to practice it and, watch how the market reacts to your level in real time. And from then on, you will get better at drawing support and resistance. And of course, right, this is only one way to draw support and resistance. In the next section, I'll share with you how you can use moving average, right, to do this, to identify your area of value as well. Okay, so moving average again. So how can you use moving average to define an area of value? So here's how. So in trending markets, for example, in an uptrend, a moving average can act as an area of value. It will look something like this. So let's say market is in an uptrend, higher, makes a pullback, another high, pullback, another high, pullback, another high. When you overlay with a moving average, let's say the 50-period moving average, you would realize that the price, right, has bounced off the moving average a number of times, once, twice, 3 times. And if you come back for a 4th time, okay, we can say that, hey, this is an area of value and this is where buying pressure could step in and push the price up higher. So which moving average do we use? We have, 1 to 1,000. For me personally, I like to use the 50-period moving average because for 50-period moving average, the trend usually tends to be a healthy trend where you can see the ebb and flow of the trends very clearly. You can see the pullback. It's not very shallow. It's not very deep. To me, it's just nice, right? The sweet spot. Of course, you don't have to use the 50-period moving average. Some people prefer shallower pullback, then they use the 20-period moving average. Some people prefer, a deeper pullback. They use the 100-period moving average. So there are, different types of moving average you can use. Ultimately, right, you have to find, right, the type of trends that you want to trade. And you might be wondering, but Rayner, how do I know whether, the moving average holds up? Sometimes I look at different charts, the price just sliced and dies through the moving average, right? Doesn't respect it. I get it. So this is why before we use moving average as an area of value, we want to make sure that the price, respects the moving average. And we use these 2 tests, right, to confirm it. So let me explain. So let's say market is in an uptrend, it makes a pullback, goes up, makes a pullback, and then goes up. And you overlay with a moving average. It has to be tested at least twice. So this is 1 test, and this is a 2nd test. So this way, if the market comes back for a 3rd time, All right, I know that, hey, this market seems to be respecting this moving average. I have more confidence, right, to use the moving average to define my area of value, having, proven itself 2 times previously. So this is what I mean by, at least 2 tests to confirm it. So let me walk you through some charts so you know what I mean. So you can see over here, this is Brent crude oil. Over here, we have 1 test. Price test the moving average once. Then it breaks above this swing high, tested a second time, breaks out above this swing high, and then tested here a third time. Okay, so we have 3 tests over here. So this means if in future, maybe for a 4th time, the price comes back to this 50-period moving average, I can say, hey, this is an area of value for this particular market, and on this time frame, I can look for buying opportunities at this 50-period moving average since it's acting as an area of value. Okay, and then in this case, right, yep, it did came back and tested I would say a 4th time over here. So now some of you might be thinking, Rayner, why isn't this a 4th test? And that's a good question. And the reason is because for me to define a test, the price must break above, the swing high or the swing low. So in this case, this was already the 3rd test. But the price, when it tested here, it did not break out this swing high over here. So I don't consider this a 4th test. The price has to break out of this swing high. Only then, when it breaks out of it and retests, would I consider it a test. Okay, so that's the way I define my test. Dollar against the Japanese yen. Same thing. If you look at this, price tested once, bounce up, tested twice, heads up higher, came back a 3rd time. We have 3 tests over here. So again, on this market and on this time frame, dollar against the Japanese yen, 8-hour time frame, I would say that, hey, the 50-period moving average, right, is acting as an area of value. I can look for buying opportunities if the market pulls back towards the 50-period moving average, since it's respecting it. In this case, I tested a 4th time and then just collapsed and break down. Aussie against the Japanese yen. So let's have a look at this and see if there's any tests. So over here we have 1 test. Price breaks out of the swing high. 2nd test, price breaks out of this swing high. Came back a 3rd test. Then start to chop. It hits higher, but eventually I think you saw what happened, right? It hits higher. So that's how you kind of define the test and use it to serve as an area of value. And just one last final example, you can see over here the dollar against the Chinese yuan. You don't have to use the 50-period moving average. For this one over here, you can see that the 20-period moving average can serve as an area of value as well. So you can see 1 test, hits down lower, 2nd test, hit down lower, 3rd test, hit down lower, and there's another 4th one over here, and 5th, and so on. So one thing to point out is that when you see this chart, that is respecting the 20-period moving average. If you look at the depth of the pullback, this one is much shallower compared to the 50-period moving average. If you look at the depth of the pullback, it's usually quite shallow compared to the 50-period moving average one, like on the, let's say, the dollar yen 8-hour. You can see that the depth of the pullback is much deeper, right? This one you can see is much deeper, and much deeper. So this, right, gives you more time, right? If the depth of the pullback is, I would say, longer, in this case of the 50-period moving average, you have more time to plan your entry, right? Compared to a 20-period moving average where, you need to scramble and act fast. So this is why I prefer, right, using the 50-period moving average to define, right, the area of value in trending markets. Okay, let's do a quick recap to what you've just learned. Number 1, area of value helps you to decide where to buy or sell. You know exactly where on a chart, right, you can look for buying opportunities. Where on a chart exactly you can look for selling opportunities. And to accomplish that, I share with you a couple of tools and techniques. You can use support and resistance or moving average, right, to help you identify your area of value. And in fact, you can actually use both as well, support and resistance and moving average, to define your area of value. Okay, I'll cover more later on. So that's what we've just covered. So at this point, right, market structure, right, tells you what to do, whether to be looking for buying opportunities, selling opportunities, or to stay out of the markets. Then we have talked about area of value, where to buy, where to sell. Now the next question is, when exactly do you buy or sell? When is the right time to click the buy button? When? Right? That's where we will talk more about it in the next section, which is called entry trigger. Hey, what's up, my friends? So let's carry on where we move on. But before we get started, I want to do a super quick recap to the topics that you have just learned. So first thing first, number 1, remember, market structure. What is it? Well, in essence, right, market structure tells you what to do. If the market is in an uptrend, you will look for buying opportunities. If the market is in a downtrend, you will look for selling opportunities. So that's what we covered, market structure, the first thing. So let's say market is in an uptrend, a series of higher highs and higher lows. Then this brings us to the second section that we have covered. We talk about area of value. And the reason why this is important is because just because a market is in an uptrend doesn't mean you want to blindly hit the buy button, because the market could be getting ready to make a pullback or a reversal. So this is where I introduced to you, right, the concept of area of value, to identify areas on your chart where buying pressure could step in to push the price higher. So in other words, these are areas on your chart where you want to look for buying opportunities. So in this case, let's say it's an uptrend, this could be an area of value, right, where previous resistance could become support. So this is an area of value. This is where you want to look for buying opportunities to hop on board the trend. And now this brings us to our third section, entry trigger. So once you have your market structure, once you have your area of value, the next question is, when do you enter a trade? So this is what entry trigger is all about. It tells you when exactly to enter a trade, when exactly to buy or sell. So to do that, right, entry trigger, we'll learn some simple price patterns, right, that you can utilize, right, that tells you when to enter a trade, right, after your earlier market conditions are met, right, namely the market structure and the area of value. So let's, study this more in depth. So how do you define an entry trigger? So there are numerous ways, but I'm going to share with you two techniques. Number one is what I call candlestick patterns. I didn't call it, right, it's the people, the traders before me, right, they came up with this concept. And then we have the moving average break. So let's, study these two techniques, right, that you can use to define as your entry trigger. So let me first and foremost explain what candlestick pattern is all about. So candlestick patterns is something that you might be familiar with because most charting platforms offer this type of candlestick charts. So it has 4 data points: the opening price, the highest price point of the day of the candle, the lowest price point, and the closing price. So I'll explain this in more details shortly. So I want you to know is that candlestick patterns can be utilized across different time frames. You can use it on the daily, the 4-hour, the hourly, the weekly time frame. And depending on the time frame that you're using, how you can interpret it is that on the 1-hour time frame, right, one candle will be formed every 1 hour. If you're on the 4-hour time frame, then one candle will be formed every 4 hours. And likewise, if you're on the daily time frame, one candle will be formed every single day. You get my point. So now this brings me to this section, right? How do you read candlestick patterns? Okay, so remember there are 4 data points. I'm going to explain to you step by step. So when you deal with candlestick patterns, right, you will likely see one of 2 types of candles, either a green candle or a red candle. Sometimes it could be a black candle or a white candle. It really depends on how you set your chart settings for. But for most charts, right, it's either green or red. So for a green candle, it simply means that the price has closed above the opening price. Okay, so in this case, right, you can see the green candle. This over here will be the opening price. This over here will be the closing price. What about these 2 black line over here and here? Very simple, right? The one at the top is the highest price of the candle, and this over here is the lowest price of the candle. Now you might be wondering, hey Rayner, what do you mean by of the candle? So this depends on the time frame that you're using candlestick pattern. So let's say, for example, you are on the daily time frame. Let's put it daily. Okay, so how do you interpret this on the daily time frame? Very simple. This means this is the highest price point for the day. This over here is the lowest price point for the day. And this over here is the opening price of the day, and this is the closing price of the day. So this only holds true if you are, looking at this candlestick pattern on the daily time frame. If you change this to the weekly time frame, then this is the highest price point of the week, this is the low of the week, this is the open of the week, and this is the closing price of the week. You get my point. Okay, now let's have a look at the other inverse, the inverse of the green pattern, which is actually this is what we call a bearish pattern. This is where the candle has closed below the opening price. Okay, so for this one over here, the opening price will be on top, open. This is the closing. This again is the high, and this is the low. So the way to interpret this bearish candle is the same. The only difference between a bearish and a bullish candle is their opening and closing price. For bullish, the open is below and the close is on top, right? Because the bar, right, has closed above the opening price. This is bullish, right? This is like a sign of strength where the buyers are in control. They have pushed the price and closed above their opening price. Whereas this one is a bearish candle where the sellers are in control, where they actually close right below right where the opening price is. So this is what we call a bearish candle. So this is actually how you read a candlestick pattern. And to sum up what I just said, this diagram will be useful. So you can see over here, this is like a quick summary to what we've just covered. This is the opening price, closing price, because this is a bullish candle. This is the high, and this is the low. Likewise, on the opposite end of the spectrum, this is a bearish candle. The opening price is here, closing price is here. Because this is a bearish candle, this tells you that the bar has closed below the opening price. So that's why the close is below the opening price. Open is here, close is here. This is the low of the candle, and this is the high of the candle. Actually, the low of the candle is actually here. Okay, so another terminology to explain is sometimes you might have heard of things like body wick. So the body refers to the colored segment of the candlestick pattern. So you can see that this colored area from here all the way down to here, this is what we call the body of the candle. And you see the two black lines sticking out. We call this the wick or upper shadow. Since this one is the top of the wick, we call it upper shadow or upper wick. The one at the bottom, we call this a lower shadow or lower wick. And that's pretty much, how you read a candlestick pattern. So now moving on, right, I want to share with you some really useful candlestick patterns, right, to help you time your entry so you know when exactly to buy or sell. So let's move on. So if you look at this one over here, let's first talk about the bullish reversal candlestick patterns, right? It looks something like, there are a few variations to it. I want to explain to you two that I find useful, right, in your trading journey. First one is what we call a hammer. So let me explain to you the story, right, behind the hammer. So the hammer, again, it's a bullish candle, so you know the opening price is here. Where is the low of the candle? It's here. Where is the closing price? It's here. Where is the high of the candle? It's here. Okay, so let's say this is like, a daily time frame candle. So this is the opening price of the day, closing price of the day, high of the day, low of the day. So let me explain to you, what's going on with this hammer pattern and why is it so significant. So if you think about this, right, this actually tells you that, when the market opened over here, the sellers, they quickly dive in, right, and push the price lower all the way down, near these lows of the day, right? And when things are looking doom and gloom, right, when things are looking so bad, right, suddenly the buyers, right, they got revived, right? They, inject themselves with, maybe some steroids and push the price all the way up higher, and finally closing near the highs, right, of the day. So it's kind of like, you watch movies, right? The good guy get beaten up, get trashed, and then suddenly, they think of some of their loved ones, it's hurting them, they got to gain strength to overcome the battle, and then they win the battle and the movie ended. So it's kind of the same story, right? Where the sellers are in control, pushing down the price, and then sellers, kind of like get strong, those cheesy movie lines, and they revive and they, beat the bad guys and they're victorious. So same as this hammer over here, right? So basically the sellers got overwhelmed by the buyers, and the price, right, closed bullishly, close near the highs of the day. So this is a sign of strength, telling you that the buyers are in control. So another pattern, right, the bullish engulfing pattern is actually a similar variation to this one, but this one is a one candle pattern, okay, whereas this one here is a two candle pattern. So this one requires two candle to define it as a bullish engulfing pattern, but the story behind it, it's the same, right? Let me explain. So if you look at a bullish engulfing pattern, you can see that on the first day, price open here, and then the sellers took control and closed right near the lows of the day. So the sellers were celebrating, right? Hooray! We're victorious. If you watch Avengers Endgame, right, how is it like, right? Where the bad guys, they were winning the war. Then what happened is that all the good guys started to assemble, right, and then push back, and then they win the war. So in this case, it's the same thing, right? The sellers thought they were winning, and then the good guys suddenly come in, right? Reinforce together, Avengers assemble, and then, they push the price up higher, right? And close near the highs of the day, and the buyers, they pretty much, won this battle between the war between buyers and sellers. So in this case, bullish engulfing pattern, similar to the hammer, sellers were in control at first, then they got overwhelmed by the buyers, and, they pretty much won the war temporarily. So this is what we call a bullish reversal candlestick patterns. Hammer and bullish engulfing patterns are useful ones to know. So if you are trading the markets, right, you notice the price is in an uptrend, it's at your area of value like at support, and then the hammer forms, right? This tells you, right, that it's time to enter a trade. So a quick illustration could be something like this. Let's say, let me just get rid of the bars here first. Oops. Okay. So if you look at this, right, let's say market is in an uptrend, comes back to your area of value here. Okay, then you got your entry triggered hammer. Okay, what this tells you that now, at this point, right, the buyers have, win the tug of war between buyers and sellers temporarily, and this is where you can look to enter your trade on the next candle open. Okay, we'll cover some trading examples later on, but this is pretty much to let you know, right, where this entry trigger stands, right, in the grand scheme of things. So now let's move on and talk about bearish reversal candlestick pattern. So there are again two to share with you. Number one, shooting star. So let me illustrate to you the story, right, behind a shooting star. So you can see over here, the price opened at this price point. This is the close, this is the low, and this is the high. So what is the story, right, behind the shooting star? So when the market first opened, right, the buyers, right, they were victorious, right? They quickly pushed the price up higher, drive the price up near the highs. And beating their chest, celebrating. Suddenly, right, the sellers came into control and pushed the price all the way down, closing near the lows. So an analogy that I can give you is like, you go for you got back your exam results and you realize, man, I got an A. Why you're so excited? I got an A. And after which you realize the A is not what you think. It means A for absent. And you come crashing down again. So it's the same thing for this shooting star, right? You were really high. You thought, you're really happy. And then your whole world just come crashing down. So same for this, right? The buyers, they took control at the start. Buyers took control at the start, only to get overwhelmed by the sellers and the price closed near the lows of the day. Okay, so likewise, there's another one, what we call a bearish engulfing pattern. Meaning is similar, just that this time around, it uses two candles to represent this so-called story. So I'll explain, right? So again, here is the opening price. This is the low, this is the high, and this is the close. So you can see that, on this day, the buyers were in control. They managed to close near the highs of the day. They were really happy, really excited, right? This is good news. Yay! The next day, sellers quickly took control near the opening price, at the opening price, and drive the price down and close near the lows of the day. So this, you can see, right, this bearish candle, right, is even more powerful than the earlier one. Why do I say that? Because if you look at the body of this red candle, this body, right, remember body is simply the colored portion of a candle. This body is even bigger than the previous bullish candle body, right? This body is engulf or cover this first candle body. So this is why we call this a bearish engulfing pattern, because this body of this candle has engulfed, has covered the body of the previous day's candle. Okay, so let me just walk you through a few chart examples so you know how to actually spot, bullish engulfing pattern, bearish engulfing pattern, and stuff like that. So you can see over here on this chart over here, Aussie against US dollar, this is what we call a bearish engulfing pattern. See how this body of this candle has engulfed, has covered the body of the previous candle. Okay, and if you look over here, this is what we call a hammer. Look at this candle over here. This is what we call a hammer, right? We can see the long wick at the bottom, right? Rejecting these lower prices. Okay, let's see what else. This is what we call a shooting star. I would say this over here. Notice this long wick up higher, right? In fact, some of you, if you want to call this a bearish engulfing pattern, I wouldn't say you're wrong, because this candle has actually covered the body of the previous candle as well. So one thing to note, right, is that when you are understanding candlestick patterns, don't get too caught up with the name, the exact definition, because the concept is really what matters, right? Who's winning the war, right? By how much, right? How much rejection of higher prices are there? How long is the wick relative to the body? This is what matters, not really the exact name and the exact meaning behind it. Because if you look at, for example, this pattern over here, which I didn't cover, okay? Let me ask you, do you think this pattern over here, is it bullish or bearish? Well, if you learn how to read the price action or read the story behind candlestick patterns, you will agree that this is actually a bullish candle. This tells you, right, at one point the opening price is here. The sellers drive the price down lower near this low. Then the sellers took control and pushed the price back up near the highs of the day. So you can see that this is actually a bullish candlestick pattern, and this is what we call a dragonfly doji. I didn't teach that to you, but using the concept of open, high, low, and close, where the price open, where the price close, who's in control, you should know that, hey, this is actually a bullish candlestick pattern. All right, so let's have a look at one or two more before we move on. So look at this chart again, you can see, this candlestick patterns, right, pretty much, quite common on the chart. This one here, we have a bearish engulfing pattern. This one here looks like a shooting star, but a shooting star, we have a red body, a bearish close, but this one here we have a green body. But just because this body is green, you won't say that, hey, this is bullish, right? No, this is still a bearish candlestick pattern, a bearish reversal candlestick pattern. Only difference is the body is a little bit green, right? Telling me that the price is closed slightly above the opening price. But the key thing to pay attention to is this long wick over here, right? This tells you that, the buyers at one point in time were over here, and it got overwhelmed by the sellers, pushing the price near, right, the lows of the day. Okay, so again, remember the story behind the candlestick pattern and not try to, understand or memorize every single pattern out there, because you will get overwhelmed. So moving on now, let's talk about the second, right, entry trigger technique that you can use, which is called the moving average break. Okay, so now I want to share with you another technique that you can use to time your entry. This technique is what I call the moving average break. So to illustrate how this works, right? So just imagine if the market is in an uptrend, right? A series of higher highs and higher lows, and then it makes a pullback. So now the question is, at which point of the pullback do you enter a trade? So earlier we talked about candlestick patterns, right? How you can use tools like hammer, bullish engulfing pattern to time your entry on the pullback. So the other technique that you can use is what I call the moving average break. So what you want to do in essence is to overlay this chart with a short-term moving average. Okay, so let's say, let me just get this one over here. Let's say this is a short-term moving average like this, right? Heading down lower because the market currently is making a pullback right now. So what you're looking for is for the price to actually break and close above this short-term moving average. So let's say this black line is the price. You need to break and close above this short-term moving average. So when this moving average is broken, when the price is break above it, we call this a moving average break, and this is where you can enter a trade. So the rules that you can use is this, right? For a long entry, you can enter right when the price breaks above the 5-period moving average. And for a short entry, you can enter when the price breaks below the 5-period moving average. And one thing to be clear is that this entry trigger, like the candlestick pattern, is not meant to be used in isolation. It's meant to be used within the context of the market, right? Market structure, area of value, and then finally look at the entry trigger. So let me share with you a few examples of how this moving average break works. So over here, let's say you have this Canadian yen. You can see that this market is in an uptrend and it's making a pullback over here. This pullback. So now you might be wondering, hey, when is is it the right time to enter a trade? So again, you can use the concept of the moving average break, overlay with a 5-period moving average. If you can't find an indicator on this platform, just go to indicator, look for moving average, right? Called moving average. Click on this and you'll find it. So I already have it on my chart. I'm just going to release this, and you can see that the 5-period moving average is this red line that you see over here. This red squiggly line on the chart. Okay, this one here. So what we are looking for is for the price to break and close above this 5-period moving average to time our entry to enter a long trade, since this market is in an uptrend. So you can see over here on this candle, this green candle, it has break and close above the 5-period moving average. This tells us that it's time to buy and enter on the next candle open, which can be on this candle here. So you can enter on the open of this candle here. So this is how the moving average break technique works. So one more example. Again, look at this. Market has broke out, and then now it has made a pullback. Okay, so now at which point of the pullback do we enter this long trade? Since we know that this market is in an uptrend, it just broke out of resistance over here. This is resistance, price broke out, just made a pullback. When exactly do we enter? So if you don't want to use candlestick patterns, you can use the moving average break. Wait for the price to break and close above the 5-period moving average to get on board the trade. So this actually happened over here. Okay, so this is an entry trigger. This is where you have the moving average break, and you can look to enter on the next candle open, which is entry will be on the opening price of this candle here. Okay, so this is a moving average break technique, relatively straightforward. So let's do a quick recap. Number one, right? Entry trigger tells you when exactly to buy or sell. Then I've shared with you, you can use things like candlestick patterns and moving average break as your entry trigger. So at this point, right, you know when exactly to enter a trade. So now this brings us to the next section, right? When do we exit the trade? What if the market moves against us? Where do we cut our loss? What if the market moves in our favor? Where do we take profit? All this and more in the next section. Okay, now let's do a quick recap, shall we? Entry trigger tells you when exactly to buy or sell. And I shared with you a couple of entry trigger techniques you can use, right? Namely candlestick patterns. You can use things like hammer, shooting star, engulfing pattern to time your entry. Then I also shared with you the moving average break technique, right? On how you can actually use the 5-period moving average to help you time your entry as well. And one last thing to note is that entry trigger is meant to be used within the context of the market. I'm not saying, no, if you spot this price pattern, if you spot the moving average break, hit the buy button. No. It's meant to be used within the context of the market, namely, market structure, area of value, and then your entry trigger. And now, this brings us to the next point, right? When exactly do you exit the trade? What if the market moves against you? Where do you cut your loss? What if the market moves in your favor? Where do you take profits? So all this and more in the next section. Boom, shakalaka, boom, shakalaka, boom. Okay, so in this section, it's all about exits. And when it comes to your exits, there are two parts to it. First part is this. Where do you exit if you're wrong? This is also known as your stop loss. Number two, where to exit if you're right. This is also known as your take profit. So let's study stop loss first, right? Where do you set a proper stop loss, right, when you're trading so you don't get stopped out too early? So when it comes to stop loss, I only have one technique. This one technique, right, serves my trading, right, to set a proper stop loss. So the one technique that I want to share with you is based on this concept. You should place your stop loss at a level which invalidates your trading setup. I know that sounds a mouthful, so let me explain. So let me ask you, right, if you look at let's say a trending market is in an uptrend. Let me ask you, at which point, right, would you say that, this uptrend is invalidated or this uptrend is destroyed? Will it be at here? Let's call it point A. Here, point B. Or here, point C. A, B, or C. Take 3 seconds. 1, 2, 3. Well, if you ask me, okay, I would say the level that this trend will get invalidated is at point C. Because if you think about this, if the market retraces down to point C, all the way down here, then clearly this uptrend isn't looking like how an uptrend should be, which is a series of higher highs and higher lows. So your stop loss should be at C, right, which invalidates this uptrend. Now, why not A or B? Because if you think about this, if the market retraces to A and continue higher, this still looks like an uptrend. If it retraces to B, goes up higher, this uptrend is still pretty much intact. So your stop loss, right, the key thing that I'm trying to bring across is that it should be at a level which invalidates or destroy your trading setup. So if your trading setup is a trend trading setup, your stop loss should be at a level, right, where your uptrend looks funny. It doesn't quite look like an uptrend anymore. So another example, let's say you are trading support resistance. Market is in a range, goes up, down, up, down, up, down. Then this is the lows of the range. This is otherwise known as support. Bounce once, twice, 3, and here 4th time. So let me ask you, at which, let's say you're long over here at this price point, where do you put your stop loss? Well, using this concept, right, your stop loss should be placed at a level which invalidates your trading setup. So at which point on this chart will support be broken? Is it over here? A? Let's call this A, B, or C. And again, I'm sure you agree, right? It's a no-brainer. It will be C. Because if the price hits down lower and hits at point C, this area of support is likely broken. If it reaches A or B, support could still be intact because support is an area on your chart and it didn't even breach the lows of support for A and B. Right? But for C, it has exceeded it by a decent margin, and there's a good chance that support is broken and your trading setup is invalidated. And that's what I mean by invalidation. So now here comes the so-called quantitative part of it. How do you make sure that your stop loss, right, is set the proper way consistently each and every time? Because if you look at the chart, you can eyeball, right, this level, that level. But if you do that over the next 500,000 trades, you can see that your subjectivity might creep in, right, and cause you to not set your stop loss properly in a consistent manner for the long run. So the way to do it, right, is that you want to use the concept of the ATR, which stands for average true range. You want to set your stop loss 1 ATR beyond the area of value. So before I talk about this technique, right, let me share with you what ATR stands for. So ATR stands for average true range, right? So average true range. So let me give you a quick crash course on this indicator. So this indicator is a volatility based indicator. So when volatility is high, the value of this indicator will be high. If volatility of the market is low, the value of this indicator will be low. So for those of you who do not know what volatility is, in other words, it measures, right, how much did the price move, right, over a given period. If it moves a lot, like a huge percentage, volatility is high. Okay, if it didn't move much, like maybe 0.1% a day, 0.05%, very small percentage change on a day-to-day basis, we can say that volatility is low. When volatility is high, the average true range indicator value is high. When volatility is low, average true range indicator value is low. Okay, so one thing to be clear, this indicator doesn't measure the trend. It measures volatility. So let's have a look at how this indicator works. So what do I mean by one ATR beyond the area of value? So let's say, let's look at the chart, shall we? So this is Brent crude oil, 8-hour time frame. So let's say, for example, okay, price came into this area of value, this 50 period moving average. Okay, so let's say you want to go long and enter on the next candle open. Maybe you think that this is a valid trading setup and you go long at the opening price. Where do you set your stop loss? Well, you want to set it right 1 ATR below your area of value. So in this case, let's say this low over here is your area of value. Is the low of this near the 50 period moving average. This is the swing low at that point in time. So let me just cover this candle. At this point in time, this is the swing low, right? The lowest point of this 50 period area of value. So what you want to do is to pull out the ATR indicator. Just search for ATR. Click on this. Comes up this one at the bottom. Go to settings. I like to use a 20 period ATR and I like to use SMA. Click OK. So how do you interpret this? Very simple. So remember, ATR indicator is a volatility based indicator. When volatility is high, the value goes up. Volatility is low, value goes down. So if you look at this portion here, this ATR value is increasing over time. Why is that? Because if you look at the chart from here all the way down to here, notice the range of the candles from here to here. What's happening? The range of the candles here are pretty much increasing in size. So when the range of the candles are increasing in size, it tells you that the market is moving more. So that's why your ATR value is increasing higher during this period. And likewise, if you look at this, why is this ATR value here going down? Well, just need to look at the chart. You look at from here to here, you notice that the range of these candles from here to here is decreasing in size. Market is moving lesser. Volatility is decreasing. That's why volatility here is heading lower. Make sense? Okay, so now, how do you use this volatility concept to set a proper stop loss? So this is what we're going to cover next. So I mentioned earlier, you want to set your stop loss 1 ATR below the area of value, right? This is an uptrend. So first and foremost, what you want to do is to find out the current ATR value. In this case, is $1, 1.195. Simple, because it's stated here. Then what is the value of this swing low over here? So looking at this trading view chart, it tells me that the low is 63.176. So what I'll do is I'll take 63.176, 63.176, which is the lowest price point here, and I minus 1 ATR, which is this value here, 1.195. And this gives me, I'm not going to calculate this with my head because I suck at this mental calculation. Trusty calculator is here. 63.176 minus 1.195 gives me 61.981. Of course, you don't have to be so exact to the exact thick, right? So you can just make it like 61.99 or 62 if you want, or 61.95 if you want to give it more buffer. So what this means, right? You're going to take this value, let's say it's 61.99, and that will be your stop loss level. So we're just going to take this tool over here. Let's call it the horizontal line. I'm going to change this to red so it signifies our stop loss, and the value is 61.99. Okay, there we go. So how do you interpret this now? So very simple. So from this extreme low over here to this red line over here, okay, this red line is 1 ATR. So in other words, this is your stop loss. Okay, so if let's say, or rather, this is the, or rather, this red line over here is your stop loss over here. So if let's say you enter on the next candle open, if you enter on this next candle open here, let's say it's here, your stop loss is at this price point, this level over here. So from here, opening price all the way down to this red line is your stop loss. Okay, so in this case, all right, you can see that you wouldn't have gotten stopped out of your trade because you had enough buffer, right, as your stop loss. So let me walk you through another example because this concept is important. So let's have a look. How about this one here? Okay, say close this. Okay, let's say over here. Let's say we have a, for example, let's say you went short, right? Maybe there's a valid trading setup and you notice this strong bearish price rejection on this candle here, and you went short. So again, where should your stop loss be? So again, the concept is you want to set your stop loss, right, 1 ATR beyond the area of value. So in this case, where is the area of value? Area of value is here, this area of resistance. So within this area of value, this is the extreme high point. Okay, so reference that high point. So in this case, the high point, the value is, let me find out what that is. It is 6.515. Okay, 6.515. So the high point is 6.515. And what I'm going to do is to add on 1 ATR. Why add? Because we are now in a downtrend, right? Our stop loss, right, should be above 1 ATR above this swing high. So the current ATR value is 0.014. So just 0.014, and that will give us, let me see, 6.515 plus 0.014. 6.529. 6.529. That is where your stop loss is. So if I were to get again, right, the red color line and to draw it out. Okay, 6.529. There you go. So let's say you enter on the next candle open, which is here. Okay. Your stop loss, let's say you enter on the next candle open is here. Your stop loss will be at this red line over here. So your stop loss is, in other words, from here all the way down to here, right? This is the size of your stop loss. Make sense? Okay, so pretty simple stuff, right? Your stop loss is, in essence, right, 1 ATR beyond the area of value. So this gives your trade room to breathe. So what this does is that if, let's say, the market makes a sudden spike up higher, right, at least, right, your stop loss is away, right, from these highs or from here. So you give your trade, right, more room to breathe and not get, stopped up from all this sudden spike up or down. Of course, it's not 100% foolproof. You will still get stopped up from time to time, but it will, protect you, right? Hopefully, more often than not. And that's the concept right behind to why I set my stop loss in this manner. Okay, so just remember this. 1 ATR beyond the area of value. So your trade has breathing room. And finally, one last pro tip is this. Some of you might be wondering, hey, Rayner, why do you use 1 ATR? What about 2 ATR or 3 ATR? Now, here's the thing. It's perfectly fine, right? You can adjust the multiple of your stop loss according to your needs. But one thing to bear in mind is that the wider your stop loss is, right, is that your position size will be reduced, right? So you can accommodate, right, your risk management. And of course, the smaller the size of your stop loss is, right, you can afford to put on a larger position size. But the downside to that is that, you might get stopped up prematurely. So again, you can, decide what ATR multiple suits you best. For me, personally, I just simply go with 1 ATR beyond the area of value. So that's pretty much it for stop loss, right? Now let's move on and talk about your exits, right, if the market moves in your favor. Okay, so now what if the market moves in your favor, right? Where do you take profit? So when it comes to exiting your winning trades, you have two options. Number one, you can adopt a swing trading approach or a trend following approach. Let me explain these two methods, right, to you, and you can later on kind of decide which of these two approaches suit you best. There's no right or wrong here. There's no, swing trading is better than trend following or stuff like that. There isn't, right? It really depends on you, the trader. So first, let's talk about swing trading. What exactly is swing trading? So as a swing trader, what you're trying to do is to capture just one move in the market, just that one swing, zoom. That's it. So to illustrate, what is a swing in the market? Let's say market is in a range between these highs and these lows. Market goes up, that's one swing. Comes down, that's another swing. Goes up, that's one swing. Come down, that's another swing. So basically from here to here, this is one swing. Here to here, this portion here is another swing. Here is another swing, and this is another swing. Make sense? I know this looks like a mess, but in other words, right, swing trading refers to capturing one move in the markets. So now the question is, how do you capture one swing? So to do it, right, you want to exit your trade before opposing pressure steps in. So let's say if you're a buyer, then opposing pressure is seller. If you are a seller, then opposing pressure to you is the buyer. Right, let me just explain, right, since some of you might be confused. So let's say again, market is in a range and you bought near the lows of support. Let's say you bought over here. Okay. Now let me ask you, if the market moves in your favor, where do you think sellers might come in, right, to push the price down lower? Well, if you know that this is a range and if you know that this is an area of resistance, you will conclude that, Rayner, I think, sellers might be at resistance, right, trying to short the market at this area. And if you think along those lines, you're not wrong. So this is what I mean by, exit before opposing pressure steps in. If you know that this is an area of resistance, you want to take profit before resistance. The keyword here is before resistance. Okay, you don't want to set your take profit level here above resistance or here. Why is that? Very simple, because if you were to set your take profit level here above resistance, what it means is that you will only exit with a profit if the market breaks above resistance. If it doesn't, right, you will watch your trade reverse 180 degree against you and hit your stop loss. Do you want that? Of course not. So this is why you want to be smart about this, right? Don't set your target above resistance, because you're making the market difficult, right, to reward you. Instead, set it before resistance, before opposing pressure steps in, because this is where you have a higher likelihood, right, of exiting your swing trade with a profit. Okay, so let me share with you a few charting examples so you know what I mean. So if you look at this chart over here, let's say for whatever reason, right, you went long on you saw this bullish candle and you went long on the next candle open. Okay, and you're trying to just capture one swing in this market. This is the oil market. This is the daily time frame. Now let me ask you, where should you exit this particular swing trade? Where should you set your target? I'll give you three options. Okay, option 1 is here. A, B, or C. All right, let's call this A, B, or C. Think about this, right? Where do you want to exit this trade to capture one swing? A, B, or C? And the answer is C. Why is that? Remember, we want to exit our swing trade before opposing pressure steps in. If you set it at A, you are making the market, difficult to reward you, because the price has to break above this swing high over here before it can reach your target, making things difficult. If you set it at B, it's not as bad as A, right? But remember, this is a swing high. This is a potential area where selling pressure could step in. There's no guarantee the price will retest this swing high before it reverses down lower. Okay, because the price could come up higher, just approaching the swing high, and then start to reverse down lower, meaning the opposing pressure, or rather the sellers, step in earlier, right, to push the price down lower. So if you want to be conservative, if you want to be smart about this, and if you want to capture just one swing in this market, C, right, would be a better option, because this is where opposing pressure, or rather this is the level, right, before opposing pressure will step in, right, to push the price down lower. Okay, so to me, C, right, is a much better level, right, to exit your swing trade. This is where you're kind of like earlier a little bit, right, and exiting your trade before opposing pressure at the swing high steps in to push the price down lower. So if you're exiting your trade somewhere here, right, you're kind of putting yourself in good shoes, because this is the swing high, this is the area of resistance, and this level is before the opposing pressure at this swing high here. Another example, this is the chart of gold. Okay, so let's say, for example, this time around, market here had a rebound. Okay, so let's say at this low, it rebound, closes green. Let's say you enter on the next candle open again. At what point, right, do you want to exit your trade to capture just one swing? If you ask me, it will be somewhere about this level here. Because let's first identify where is the swing high and low in this chart. So the swing high is at this price point. And the key thing here is to exit your trade before the swing high, before opposing pressure steps in. So this is ideally, right, probably somewhere about here is where you want to exit your swing trade. So if the market you enter over here, this over here is where you are likely to exit this particular swing trade. This over here is before this swing high here. Make sense? Okay, now let's talk about the pros and cons of swing trading. So first thing, right, swing trading, the pros is that it has a higher winning rate, right? Because you are consistent in capturing your swing, right, from one trade to another, and you are usually exiting your trade before opposing pressure steps in. So your winning rate should be higher. The downside to swing trading is that you are unable to ride trends, and that's because you will exit your trade at a predetermined target. And if, let's say, the market, exceeds that target and continues, right, moving in that same direction, you will be on the sidelines, right, unable to reap profits from it because you have already exited that position. Okay, so this brings us to the next type of trading, which is trend following. And this is for you if you want to ride trends in the market. So what is trend following, right? It's in essence, right, trying to ride a trend. So it's different from swing trading where you're just capturing one move. No. Riding a trend, right, is trying to capture the meat of the trend, right, to ride the waves, right, as it continues to go higher. And to do that, right, you will use a trailing stop loss. So there are different types of trailing stop loss out there. The one I'm going to teach you is moving average trailing stop loss. So depending on the type of trends that you want to capture, whether it's short-term, medium-term, or long-term trend, right, you can use different moving average parameters, right, to meet your needs. So in essence, right, what you are going to do is that, let's say the market is trending higher. Okay, you're going to overlay this trend with a moving average, something like this over here. And as long as the price is above the moving average here, you will continue to hold the trade. Only if the price, pulls back and then finally closes, let's say the candle closes below the moving average, right? Then you exit the trade when it closes below this moving average. If not, you continue holding the trade, right, and see how much of a trend you can capture. And which moving average parameter to use depends, on what you want, whether you want to capture a short-term trend, medium-term trend, or a long-term trend. So if you want to capture a short-term trend, right, you can exit the trade when the price closes below the 20-period moving average. If you want to ride a medium-term trend, you can exit when it closes below the 50-period moving average. And if a long-term trend, you can exit when the price closes below the 100-period moving average. So there's no best moving average settings here, right? In case you're wondering, some of you might be thinking, oh, okay, Rayner, so which moving average is the best to ride a trend? There isn't, right? Unfortunately. So there's pros and cons to trying to ride a short-term or long-term trend. So for short-term trend, right, the downside is that you might get stopped out of your trade too early, right? Maybe it could be just a pullback, but because it already hits your short-term trailing stop loss, you are out of the trade. But the good thing is that, for trying to ride short-term trend, right, you don't really have to endure too much pain because the depth of the pullback is usually quite shallow that you have to endure. And if you endure any further, you are already stopped out. Compared to, let's say, a long-term trend, right? The good thing about long-term trend is that it keeps you in the trade longer. So even if the pullback can be deeper, there's a good chance that you can still be able to ride it out and continue riding the trend. The downside, right, to riding a long-term trend is that it's going to be more painful because you can see that the amount of open profits that you have to give back, right, while trying to ride the long-term trend is a lot more. So when the pullback occurs, right, you will see your open profits get smaller and smaller and smaller, and it can be emotionally, right, more difficult, right, because you watch a huge chunk of your profits, get returned back. So there's kind of like the pros and cons to, short-term trend following and longer-term trend following. And again, there's no right or wrong. You have to find the one that suits you best. So just to illustrate a quick chart example, so let's say this is the chart of Brent crude oil. Okay, if you, let's say for whatever reason, maybe you got long somewhere about here, let me just change. Let's say you got long for whatever reason, right? I don't know what the reason is. That's not important. Let's say you buy somewhere here and the market moves in your favor. So you can see that if you overlay for 20-period moving average, you will be pretty much, exiting your trade probably when this candle breaks and closes below this 20-period moving average. So you can capture, pretty much this portion of the move. And if you go with, let's say, a 50-period moving average, you can see that you are in the trade longer because when this candle closed bearishly, right, it did not close below the 50-period moving average. So you can see, right, that you're actually in this trade, right, you're able to withstand more pain, in other words, right, by using a slightly longer-term moving average. In this case, you would have, exit the trade over here on this candle when the price breaks and closes below this 50-period moving average. And finally, if you go with a 100-period moving average, in this case, you can see that you can endure even more pain, right? And you will be pretty much still in this trade, right? You wouldn't have gotten stopped out on this pullback here. You will have to, kind of withstand that pain and then eventually watch the market bounce back in your favor. So again, I'm not here to say, whether the 20-period moving average is best, the 50 or the 100. This is something that you have to decide and be comfortable with for yourself, right? And to decide, what type of trend you want to capture, whether is it long-term, short-term, or medium term. And that's how trend following works. And you have to be comfortable, right, with giving back your open profits. Because for example, if you saw earlier the 50-period moving average one, right, you are not going to exit. You're not going to be like a swing trader where you manage to exit, right, let's say before this swing high over here. Okay, you're only exiting your trade after the market has pulled back and moved against you. So you can imagine at one point in time, right, your open profits, right, is at a maximum, right, around this high over here where the market is really bullish in your favor. And you saw your open profit slowly dwindle and then, decrease, right, as the pullback occurs. So this is something that as a trend follower, you have to be prepared as well. This is the only way, right, you will ride the trend is by to be able to give back open profits. That is kind of like the cost of being a trend follower. So with that said, right, let's talk about the pros and cons of trend following. The pros is that you can ride massive trends. Okay, and it can be a huge profit potential for you. The downside to it is low winning rate because you're always, right, trying to attempt to ride the trend using a trailing stop loss, right? You will only exit the trade after the market has moved against you. So this usually results in a lower winning rate compared to a swing trader. So really, it depends on the type of person you are. If you hate being wrong, right, then swing trading is probably for you. But on the other hand, if you're someone that really wants to ride trends, right, you can't stand missing out on trends, then trend following is probably for you. But you have to embrace, right, the so-called downside that comes along with it, namely a lower winning rate. Okay, I get it now. You are probably feeling overwhelmed, right? What is this, Rayner? Market structure, area value, Avengers, absent for exam. What's going on? So I get it, right? You are overwhelmed. You might even be, a bit confused. But don't worry, because in the next section, right, I will share with you, right, how you can actually utilize all those different concepts, strategies, and techniques that you have just learned, right, to trade the markets. In fact, right, my own trading strategy, right, is based on all these concepts that I've just shared with you. I will share with you, how to actually use it, right, to profit in bull and bear market. So all this and more in the next section. Breathe in, breathe out. Let's go. Okay, so now before I share with you my own trading strategy and look at some real world trading examples, I think it's important, right, to take a step back and actually do a recap to all the things that you've learned up to this point. So let's get started. So number one, right, the first thing about this technical analysis training is to share with you, right, market structure. And this is important because if you can define the market structure, then you know what to do. If the market is in an uptrend, you should be looking for buying opportunities, not selling, because you don't want to be trading against the trend. You want to be trading along the path of least resistance, to be trading in the direction of the trend. So that's what market structure does. It helps you define what's the trend so you can trade in the direction of it. So if the market is in a downtrend, then of course you look for selling opportunities. So next thing we covered is area of value. And this is important because just because the market is in an uptrend doesn't mean you want to blindly hit the buy button, because the market could be overbought, it could be getting ready to make a pullback or a complete reversal. So this is why we want to be trading from an area of value. This could be things like support and resistance or moving average. So for example, if the market is in an uptrend, we want to be looking to trade at support, around support area. Then this brings us to the third section, right? Entry trigger. So once the market is in an uptrend, it's at an area of value, then we look for a specific price pattern called an entry trigger to tell us when exactly to enter a trade. The entry trigger gives us some trigger, right, to tell us that, hey, at this point, the buyers, they are in control. They are starting to, turn up the heat, right? It's a good time, right, to now enter our trade and to time our entry. So once we have the entry trigger covered, we then look to cover our exits, right? What if the market moves against us? Where do we cut our loss? What if the market moves in our favor? Where do we take profits? And that could be, depending on whether you want to be a swing trader or a trend follower. So we covered all these different techniques. So in essence, right, what you're trying to do as a technical trader is, there are many ways to this, but this approach that I'm sharing with you is to trade with the trend. So again, number one, let's say we have an uptrend, series of higher highs and higher lows. Next thing we look for is for the market to come into an area of value. So in this case, let's say the market come into this previous resistance, which becomes support. The third thing we look for is a valid entry trigger. So let's say we have something like a hammer, right, to tell us that the buyers are in control and we can look to enter on the next candle open. So once we have that, right, we want to cover our downside and to know where to exit the trade, if the market moves in our favor. So that's where we set our stop loss, which is beyond the price structure, somewhere here, and for targets could be just before this swing high over here. So at this point, you can see that we have defined the market condition that we are trading. We know when to enter, we know when to exit if we are wrong, and we know where to exit if we are right. So if you think about this entire training on technical analysis, right, is sharing with you this trading strategy called, it's like a formula, right? Call it MAEE, the May formula. And this trading strategy is not cast in stone. It is robust because you don't have to just trade uptrend, you can trade downtrend. You don't just have to use support resistance as your area of value. You can use things like moving average. You don't have to use candlestick patterns, right, for entry trigger. I shared with you the moving average break that you can use as well. You don't have to be a swing trader if you don't want to. You can also be a trend follower, to ride massive trends. So you can see that this trading strategy, it's robust in the sense that, you can tweak it right to your needs. And of course, there are more techniques and concepts that you can use as a trader. This that I share with you over here are the ones that I personally use, right? Of course, if you want to use different methods to define your entry trigger, like, chart patterns and whatnot, it's entirely up to you. So right now, what I'm going to do is to share with you some real world trading examples and see how this May formula, to see how this trading strategy, right, can help you profit in bull and bear markets. So let's get started. So first one here is the chart of Canadian against the Japanese yen. This is the daily time frame. So remember the May formula. So first thing we are looking for, number one, is M. What is the market structure? Uptrend, downtrend, or range? So I'm sure you can agree with me that this market is in an uptrend, right? A series of higher highs and higher lows, so uptrend. So once you know that the trend is up, do you want to be buying or selling? I'm sure you can agree that you want to be a buyer. So where do you want to trade from? Where do you want to buy? From an area of value, and in this case, the price is at this area of value, right, at this support. So let's call it the area of value is at support. Entry trigger. Do we have a valid entry trigger that tells us the buyers are temporarily in control and the market could hit higher? And in this case, we have a bullish engulfing pattern on this candle here. So I'll call this, I'll call it a BE, bullish engulfing pattern. What about exits, right? Do you know where to exit if you are wrong? So if we are wrong, right, I want to set my stop loss 1 ATR below this low, which is somewhere about here. As for target, I can set it right just before this swing high, which is possibly around the $88 price point. So you can see at this point, we have covered the market condition that we are trading, the area of value we know where to enter from, we know when exactly to enter or trade and when exactly to exit, right, if the market moves in our favor or against us. So I'm going to go one step further and share with you, where exactly to set your stop loss and target. So just to do a quick recap, when we set stop loss, right, for me personally, it's always 1 ATR below the area of value. So this is the extreme low in this area of value. I find out what is this value and minus 1 ATR. ATR stands for average true range. So you can see over here, this ATR value currently is about 0.7, about 70 pips. And this low of this candle, right, from what I last checked, this is about 85.42. So I'm going to take this low over here, okay, 85.42, and I minus 70 pips. That gives me, okay, trusty calculator is here, 85.42 minus 0.7, that gives me 84.72. That is my stop loss level on this trade. So let's say the market, open on the next candle open, okay, over here. Let me just share with you where I will, set my entry, stops, and exits, okay? So let's call this entry, which is at the open of the next candle. I'll change this to, let's say, green, okay? So that's my entry point. Now, what about my stop loss? We just calculated it. Your stop loss will be at 84.72. Let's put it to red. Okay, let me just change this to 84.72. That is my stop loss. Okay, and let's say we want to go with a swing trading approach. We want to exit, right, and capture just one move in this market. So for this one here, we can exit just before this recent swing high. I'll put it, let's say, around the $88 price point. Let's set this to blue. Okay, and there you have it, right? So from this strategy, right, you know exactly where to enter, where is your stop loss, and where to take profit if the market moves in your favor. And you're trading in the direction of the trend from an area of value. I hope this makes sense. Now, let's move on to another example. Okay, now let's have a look at example 2, right, and see how this trading strategy, right, can be tweaked, right, using the techniques that I've just shared with you. So again, once again, applying the May formula, right, market structure, this one here, again, it's in an uptrend. Area of value, you can see that this right now, the price has retested previous support, previous resistance, which could become support. Okay, so we have this over here. And then entry trigger. Okay, do we have a valid entry trigger to go long? So let me share with you, instead of, let's say, using bullish reversal candlestick patterns, right, we can also use the moving average break technique that I've shared with you. So let me just overlay with the 5-period moving average, as you can see over here. And notice that this candle has break and close above the 5-period moving average. This candle here has break and close above the 5-period moving average. So we have a valid entry trigger to go long. What about exits? Again, we can set our stop loss 1 ATR below this low and target just before this swing high over here. So let me again share with you how to set your stop loss and target, so you can see where exactly is your entry, stops, and target. So let's say we enter on the next candle open. It will be over here. Okay, this candle open. Let's change this to green. Let's say our stop loss is 1 ATR below this low. So find out what is the ATR value. At this point, it's about 53. Okay, let's say on this candle here, the ATR value is about 53.5. Find out what is this low. The low price over here, it's 1110. So quite simple. You just take this extreme low over here is 1110 minus 53.5. Oh, sorry, minus 53.5. Okay, 1110 minus 53.5, and that will give you 1056.5. 1056.5. So what you're going to do is to set your stop loss at 1056.5. And let me just share with you over here. Say stop loss is red, and the level that we will use is at 1056.5. There you have it, our stop loss. What about target? So again, let's say we are going to go with a swing trading approach. We want to capture one move, and for a swing trader, you usually want to exit your trade before opposing pressure comes in. So where might opposing pressure come in? Well, you can see that there is this swing high over here. So it would be prudent, conservative, right, to exit before this high over here. So I would say, you know, a good level will be somewhere about here, 1293, 1295. Okay, let's change this to blue. Okay, so let's say 1294. Okay, and there you have it, right? So again, in this example, you know where exactly to enter your trade. So let's do a quick recap. Market structure, it's up. We are trading from this area of value where previous resistance becomes support. We have a moving average break as our entry trigger. So we enter here on the next candle open, which is on this candle here. We enter here. Our stop loss is 1 ATR below this lows, which is here. And our target, right, is just before this most recent swing high, which is this blue line over here. And once again, right, I'm using the same strategy that I've shared with you, the May formula. The only difference is, right, we have changed our technique, right, for the entry trigger. We use a moving average break to enter our trade. So now let's move on and look at another example. Okay, so example 3, right? This time round, let's look at a downtrend, shall we? So we can see that you can make money in bull markets and even bear markets. So in this case, this time around, you can see this market dollar against the Chinese yuan. This one is on the 8-hour time frame. Let's apply the May formula and, you know, see how we can trade this market. So again, market structure, you can see this time around, it's in a downtrend. Okay, so market structure is down. Area of value. Okay, so this one is interesting stuff, because if you look at this area of value, you will realize that, hey, the market has retested previous support, which became resistance, and possibly at this area of resistance again. So area of value and resistance. And another thing is, if you overlay with the 50 period moving average, you would realize that this market also seems to be respecting the 50 period moving average, right? It tested a number of times, you know, somewhere here, although it exceeded by quite a little bit, right? But I would still consider this, you know, the moving average as an area, and it had a bounce, right? A number of times here, and now we're back here again. So you can see that the 50 period moving average is also acting as a confluence, right, at the area of value. So your area of value is kind of stacked right now. You have the resistance and 50 period moving average. So that makes the area even more powerful. Then what about entry trigger? So if you look at this entry trigger, we have something, bearish price rejection. It's not a shooting star, it's not a bearish engulfing pattern. The exact term is called a dragonfly doji, but again, the name is not important. What's important is that you can see, right, that the sellers are in control as you saw the price, right, being rejected higher. At one point in time, right, the buyers were in control and the price was trading near these highs. And then the sellers took control and push the price down lower and back to the opening price and closing right near the lows of the day. So this to me is a bearish price rejection. Okay, if you are not sure about it, you can, you know, wait a couple of days and see and watch the price action, and you will realize that what happened next, all right, was that this market is bullish and then followed by a bearish engulfing pattern over here. So if this one, you know, made you undecisive, right, this one should have sealed the deal, because this tells you that the sellers are in control. It's a bearish engulfing pattern. The body of this candle has engulfed the body of the previous day candle, sellers closing near the lows of the day. Okay, so this, right, would serve as an entry trigger for you to go short on the next day open. So let's say you go short on the next day open, which is let's say here. Okay, short here at the opening price. Let me just change this to green again to be consistent, right? Green for our entry. As for stop loss, right, I am going to be quick about this. I'm not going to go through the entire ATR calculation because you should be a pro by now. So I would say your stop loss, right, would possibly be 1 ATR above this high. Somewhere about here is your stop loss. Okay, let's call it S. And your target can be just before the swing low. So let's say this swing low you're referencing, this could be your target. Okay, so this, let's call it T. The green over here, this level here is your entry. Let's call it E. Okay, so if your entry price, you know where to set your stop loss, and this is your target. So now let's move on to another example. Okay, so for this one here is the chart of Aussie against the Swiss franc. this is the 8-hour time frame. So let me, again, walk you through the trading strategy, market structure. You can see that this market structure is in an uptrend. So market structure, uptrend. What about area of value? So once again, right, this is at area of support. And on top of it, if you overlay with the 50 period moving average, you can see that it tested once on the 50 MA, twice, and then a third time over here. And now we're back here again. So you can see that this again is a powerful area. It has the confluence of support and the 50 period moving average, which is respected by this market and on this time frame. What about entry trigger? We can see a bullish engulfing pattern over here. And if you don't want to go with a candlestick pattern as your entry trigger, you can use the moving average break, in this case the 5 period moving average. You can see the price also break and close above the 5 period moving average. So that's another valid entry trigger, depending which one you want to use, whether you go with a moving average break or a bullish reversal candlestick pattern, both, right, will give you the signal to go long. So stop loss, again, simple stuff, right? We will set our stop loss 1 ATR below this low. So let's say we enter our next candle open, which is here. Stop loss 1 ATR below this low, probably somewhere here. As for target, before this area of resistance, possibly somewhere about here. Okay, so again, we have our entry, we have our stop loss, and we have our target. And in this case, right, this trade pretty much went in our favor and then collapsed and hit our stop loss. So you can see this part here, it went in our favor and then collapsed and hit our stop loss. And the message behind this is to share with you that, when you trade, all the stars can align, right? And that trade can still end up being a loser. So you have to be prepared for this. You have to practice sound risk management. Don't go all in and, risk 50% of your account or 100% of your account on one trade, because these things can and do happen. So be prepared for it. Now, moving on. Next example. Okay, so another example. This one here is the trade of copper. So I want to say the May formula, but you probably get sick and tired of, Rayner, May, right? Irritating me. So again, the May formula. And again, let's have a look at this, right? Market structure, no brainer. This is in an uptrend. Okay, we both get it. Area of value. So in this case, this one here, you can see the price coming slightly into this swing low, the support, fair enough. And on top of it, you also have the 50 period moving average as what I'll show you right now. So you can see over here, the market has tested the 50 MA once, twice, 3 times, and now back here for a 4th time as well as having this area of support. Then, entry trigger. Okay, so let's say we go with the candlestick pattern. We have a bullish hammer that is formed on this candle here. Okay, market close higher for the day. So we have our market structure, we have our area of value, we have our entry trigger. What about exits? Where is our stops and target? So let's say stop loss again, 1 ATR below this low. Let me just walk you through, okay? So what is going to happen is that you will enter on the next day open over here. Stop loss 1 ATR below the low, let's say somewhere here. So this is S, and this is E, entry. Okay, I'm not going to work out with you where to set the exact stop loss level, because you should be a pro by now. I did a number of examples, so go through the earlier training if you have forgot about it. And now, what about target? What if the market moves in our favor? Where do we exit our trade? So if you recall, right, I shared with you 2 techniques: swing trading and trend following. So earlier examples has been solely focused on swing trading. So now what if we want to ride a trend? So what you can do is you can use a moving average, like the 50 period moving average, right, to trail your stop loss. So this means, right, only when the market breaks and closes below the 50 period moving average, then you exit your trade. So you can see for this example over here, the market went up higher, right, and hasn't close below your 50 period moving average. Well, in fact, it did, right? It did close below the 50 MA here at this point. Okay, but remember, your initial stop loss is actually 1 ATR below this low, which is somewhere here. So your initial stop loss is not hit. So of course, right, for me, I would adhere to the original stop loss rather than exiting the trade prematurely. And once it moves in your favor, right, you can start trailing your stop loss using the 50 period moving average. And till now, the market is still moving in your favor. So of course, this is a cherry pick example, but it's to illustrate to you how you can actually trail your stop loss to ride massive trends. So in this case, let's say what happened now is let's say the market suddenly, right, collapse and breaks and close below this 50 period moving average, which is this blue line over here. Then you exit your trade the next day. So this is how you trail your stop loss to ride trends in the market. Now, moving on to another example. Okay, so this one here is a stock trading example, and the reason why I'm sharing this with you is to let you know, right, that the concepts, the strategies and techniques that you've learned can be applied right across different markets, forex, stocks, commodities, futures, etc. So this stock here is FCX, the ticker. So again, same concept. Market structure is uptrend. Price has retraced into this area of value, right? Previous resistance, which became support. Previous resistance now becomes support, and back here once again. Let's say our entry trigger, we go with a moving average break. So let's pull out the 5-period moving average, and you can see that this candle over here has break and close above the 5-period moving average. So you enter on the next day open. So next day open, market here. Okay, good. So on this candle, you enter on the next day open over here. Stop loss 1 ATR below this low, which is somewhere about here. And let's say this time around you want to write a trend and you decided to write a longer term trend. So what can you do? You can trail your stop loss using a 100-period moving average. So let's see what happens. So let's say the market moved in your favor. In this case, of course, because I cherry picked this chart, and you overlay with the 100-period moving average. So you can see over here, right, the price is still above the 100-period moving average. So only, right, when the price breaks, let's say breaks and close below this 100-period moving average, only then will you exit this trade. If not, you will hold this long position, right, till the trend, right, hits your trailing stop loss. So of course you can imagine, right, as a trend follower, in this case it's a long-term trend following a stop loss, right, you will be in this trade for a much longer period compared to someone who is trying to capture a short-term trend or someone who is trying to capture a swing. So again, something that you have to be prepared for. And finally, right, let me share with you a few examples, right, of trade that I do not want to take. Okay, now let's have a look at this chart and find out why this is a trade that, or rather this is a market that I'm not interested in trading right now. So again, using the same formula, market structure, it's up. Area of value, it's somewhere about here. Okay, around the $42 price point. Is the price at this area of value? Not quite. So let's give it 1x, right? No. Entry trigger. Do we have a valid entry trigger? At this point, we have kind of like a bearish looking candle, right? I am interested to buy. I don't want a bearish reversal candlestick pattern, so entry trigger is no as well. So if you don't have an area of value that you're trading from, if you don't have any valid entry trigger to enter a trade, you have no business trading. So this is a trade, is a no-go, and let's move on to something else. So usually it's going to be very quick, right? Once you realize that the price is not at an area of value, you can skip it altogether. You don't even need to bother whether there's a valid entry trigger or not. Because if it's not at an area of value, why do you want to bother, taking such suboptimal trades? So quickly, you can move on into something else. So if you look at this chart, another example, pound against the Japanese yen, you can see this one here. Market structure is up, area of value is here. At this point, the price is kind of like in the middle of nowhere. It's not near any area of value, and I have no business, right? I have no interest wanting to trade this because again, the price is not at an area of value. Why do I want to force a trade? Yes, it's in an uptrend, but from the looks of things, right, it's currently, seems to be wanting to make a pullback, right, and to reverse lower. So if I were to buy right now, I'm putting myself in such, unfavorable, situation. Does it make sense? Hey, what's up, my friend? So at this point, right, you have learned a lot about technical analysis. We talk about things like market structure, support resistance, entry trigger, stops, target, swing trading, trend following, etc. And to be honest, right, all this will give you a strong foundation, but we are just scratching the surface. There's a lot more that you can dive deeper, right, if you want to be proficient to master technical analysis. And if that's what you want, right, then I recommend, right, you get a copy of this book over here. It's called Price Action Trading Secrets. I'll put the link somewhere below this video, or you can go directly to this link over here, priceactiontradingsecrets.com. This is a 140-page physical color trading book where I'll share with you, right, price action trading strategies and techniques, right, that you can use to trade the financial market. So if you've enjoyed this training so far, this book here will take you towards the next level. We talk about things like support and resistance again, but at a much deeper level, how to tell when support resistance will break, how to draw support resistance, how to read candlestick patterns like a pro, different type of candlestick patterns that are worth learning. I'll share with you reversal trading strategies, breakout trading strategies, how to manage your risk so you never blow up another trading account, and much, much more. So you can see that there's a lot packed into this 140-page physical trading book. And also, right, if you get a copy of this book today, I'm going to throw in a few bonuses, right, for you. Bonus number one is a digital copy of Price Action Trading Secrets. So this book is a physical book. It will take some time to reach you, about 3 to 4 weeks. But if you want to get your hands on it immediately, the first bonus I will give you is a PDF copy of Price Action Trading Secrets. So the moment you check out, you will get the instant PDF version that you can start reading immediately without waiting for a few weeks for your book to arrive. Bonus number 2 is this position sizing calculator, so you never blow up another trading account. I'll share with you how to use this calculator so you know how many shares of stock to buy, how many units of currencies to trade, so you won't, blow up your account just because of one trade going wrong. And finally, I'll share with you this webinar. It's called Part-Time Trading Secrets, how you can actually be a consistently profitable trader without quitting your full-time job. All this and more, all these bonuses will be sent to you instantly, right, when you get a copy of Price Action Trading Secrets. And here's the thing, right? I know that there's a lot of trading books out there, and so here's my 100% risk-free guarantee to you. So when you purchase Price Action Trading Secrets today, and within 60 days, right, if you find it that it's not to your liking, you don't get any value out of it, just let us know. Just email support@tradingwithrayner.com and we'll gladly refund you in full. No questions asked. And you can still keep the book and the bonuses. How's that for being fair? So if that interests you, just go down to the website, priceactiontradingsecrets.com over here. If you just click any of this blue button here, like this blue button here, or this any of the blue button here or here, you will be brought up to the bottom of the page. Just fill in your details and we will ship out the book immediately, right, to you as soon as possible. So with that said, I wish you good luck, good trading. I hope you've enjoyed this training. I will talk to you soon.